Hi everyone, it's Nick Jerusalem here with the Jerusalem's Happy Home team, and just checking in to provide a 2018 Seattle real estate recap and forecast for the rest of the year, and address the big question of whether or not the Seattle real estate market has shifted. Because chances are you've probably seen some articles like this one that prices are coming down, or this one that there's more inventory on the market, or this one suggesting that the market's shifting potentially. Could this be another bubble, another collapse? So before we can really forecast the future, we should first take a look at where we've been. And so what we're looking at here is our inventory levels over the last 10 years in King County. This is for homes and condos. You can see 10 years ago, we had about 17,000, almost 18,000 homes for sale. When you compare that to today, we have currently 4,000 homes for sale as of last month in King County. We literally had 4 times as many homes for sale 10 years ago than we do today. Inventory is still tight, though, you can see historically speaking, but an important thing is there's this uptick here that you can see that I'm circling with the mouse. And so the month of May actually had the largest amount of new listings come on the market in over 10 years. So while inventory is still very tight, we are finally starting to see it turn a bit of a corner. And then if we look at what prices have been doing, so we can see same thing 10 years, looking back in King County, houses and condos, you can see that the prices bottom out in February 2012. Median sales price is right around 300,000, whereas today we're currently at 600,000. So home prices have more than doubled, or essentially doubled rather, in just the last 6 years. The other interesting thing that you can see is that up here, these last couple months, that it stayed flat. And this is the first time since 2012 in February, springtime, that prices did not go up month over month. So why is that? Is this a seasonality thing? Are bigger things happening right now? Part of it is definitely seasonality. This is looking at the absorption rates, which, not to turn this into like a boring stats class, but essentially this is the percentage of properties listed that are selling each month. And it provides a really good visual representation of how quickly inventory is turning over. And you can see, looking back over these last 5 years, it's very commonplace that it tends to peak right around March, April, May in the springtime. And then we have a real sudden drop off through the summertime. So a couple of explanations for that is that, one, when the market's going like this and it's taken off like a rocket ship, everything's getting multiple offers, bidding wars, every sale is essentially setting a new record price. And so when someone's getting ready to put their home up for sale, they look at what their neighbor sold for and think, okay, they got that price, maybe we can reach a little higher. And again, when it's taken off like this, you can reach higher, and that usually does work. But eventually, people start over-testing and overreaching the market, and that historically happens right around May. This year, it actually happened a little sooner, happened in March. And then also you can see that our decline in the absorption of sales has been greater and more drastic than it has been in the last few years as well. Moving up from 168% absorption down to 66%. 66% are levels that we haven't seen in the last 4 years. So there is some summer seasonality to affect this, but these are some relatively bigger shifts in terms of new inventory, lateral price moves, and a very significant drop in absorption. So the other thing we have to look at is, okay, we see supply is turning up. What is controlling demand right now? So you have interest rates. So this is looking back over the last 4 or 5 years for 30-year fixed mortgages. See, interest rates right now are hovering right around 4.5%. That's about 0.5% higher than where they were at the beginning of the year. And 0.5% doesn't sound like a lot, but 0.5% change in your mortgage rate has the equivalent impact on your payment and affordability as a 5% change in purchase price. So rate changes can make a big difference. And you can see that they kind of took a big jump up after the election back in 2016 when the stock market rallied. A lot of people pull money out of treasuries and mortgage-backed securities into the stock market to get higher returns. Rates crept up to around 4% or so and then never really dipped much below that floor for a while. So rates are creeping up. That kind of limits some people's buying power. The other thing is, what is the economy doing right now? Now, you may have heard earlier in the year, there was a proposition for what they call a head tax in Seattle. That basically taxed all the major corporations earning over $25 million in earnings, and it would have a per employee tax. And when this came out, it would have cost Amazon, about $25 million. And so they had threatened to stop construction on one of their new office buildings that they were building. And so that caused, everybody to kind of pump their brakes because, understandably so, Amazon, as you can see here, has the largest concentration of an urban employment campus out of any city and any company in the entire country. So you have Amazon, this is last year's data, but they have 8 million plus square feet in Seattle right now, which is the largest in square footage and also large in percentage share of a city's office space. So they are a huge, huge player, and anything that Amazon does can likely cause people to be a little spooked if they're talking about, headquarter 2 or pausing construction. Obviously, they're not the only player in town. You have companies like Facebook is quadrupling their size. Google has a campus that's going to be opening in the next year or two that's going to have 4,000 employees downtown. And, we are obviously heavily invested in tech in the Puget Sound and Seattle area, but not completely so. We have Boeing with 80,000 plus employees. You have, Expedia, T-Mobile, Nordstrom, Starbucks, one of the largest port systems on the West Coast. We have a diversified economy, and those job growths might be slowing down, but they're not. The jobs aren't leaving. Unemployment is still under 4% right now. So we see that the demand from the growth there, the whole head tax shakeup, Amazon pausing was maybe the first sign that Seattle has a bit of a chink in its armor, and it doesn't have just unending growth in its potential. The other thing that's shifted recently this year is foreign investment. So 2016, Vancouver, Canada, implemented a foreign investment tax, and that quickly saw a lot of investors from overseas that were buying in the Vancouver market come down to the Seattle area. And we had a big impact for about the last 2 years from international investment. That's since has shifted significantly, largely in part due to the changes in regulations and what, you can do taking money out of China. Also, the currency has been fluctuating. So some of those things have caused some of that shift as well. So, kind of the punchline of this is that, we are likely seeing ourselves entering into a bit of a market shift, and we needed it because, inventory had been at 22-year lows for all this time. Job growth has been on this unending tear. And we're finally getting a bit of a breather in the market, which is good. We can finally get to a balanced market. I think we'll likely see prices slide, keep kind of a horizontal or plateau. We're finally hitting that ceiling of what all the jobs in the area can afford. We may see prices dip a little bit if people are kind of sitting on the sidelines longer, just waiting to see what happens, because people are always fearful to buy at the top, or, when there's uncertainty, they want to wait and see. And so it's hard to obviously predict what the future is going to hold, but I think we're going to see this market kind of temper out a little bit. The other thing is there's a lot of people that haven't entered the marketplace yet that likely will be. You had over 1,100 people coming to the Seattle area since 2010. And a lot of those folks are renting because they're new to the area. So you have a lot of folks that are renting in the area, rental market softening right now. They're not getting the squeeze from high rents, so they can now finally maybe enter the marketplace to buy as well. And then you have a number of other demographics that haven't really come to fruition yet either. You have the baby boomer population, 85 million plus folks that are reaching retirement age, likely going to maybe do some transitions in their housing and lifestyles. You have their kids, the millennials or Echo boomers or Gen Y or whatever moniker you want to attach to them. That's close to 90 million people, and they're going to be in their 20s and 30s, prime earning years, likely coming back into the market too. So all of this is just generalities of kind of the larger trends. To see specifically what this means for you and your plans, please feel free to reach out to us online at happyhometeam.com.